On the same day the Bank of Canada warned that interest rates may need to rise again, a British oil major announced it would spend $16.4 billion to plant its flag deeper into Canadian soil than any foreign energy company has in a decade. The S&P/TSX Composite fell 265 points on Wednesday, closing at 33,318. The Bank of Canada held its benchmark rate at 2.25% for the fourth consecutive meeting, but the language surrounding that decision sent a chill through equity markets that had nothing to do with holding. Governor Tiff Macklem said if oil prices remain elevated and begin to spread through the broader economy, consecutive rate increases could follow. That single phrase rewired the room. The Canadian dollar steadied at 73.09 cents US, not on confidence, but on rate hike speculation. Oil, meanwhile, pushed past $110 a barrel on reports the U.S. is tightening its blockade of Iranian ports. There's definitely no more easing on the table, said Hadija Jatau of McKinsey Investments after the decision. She is reducing exposure to cyclical sectors and moving toward inflation-linked bonds. That is the sentiment Canada's markets closed on Wednesday. And yet, buried beneath the TSX decline and the hawkish central bank language, SHEL announced a definitive agreement to acquire ARC Resources for $16.4 billion in enterprise value, a 20% premium over its 30-day average price, adding roughly 2 billion barrels of oil equivalent to Shell's reserve base. For most of the last decade, the story of foreign capital in Canadian energy ran in one direction: out. ESG mandates, pipeline blockages, and regulatory uncertainty pushed international majors to write down Canadian assets or exit entirely. Shell itself sold its oil sands interests in 2017. The direction of travel seemed settled. Wednesday's $16.4 billion acquisition of ARC Resources reverses that narrative in a single transaction. ARC Resources operates in the Montney Formation across British Columbia and Alberta, a basin the industry now considers one of the lowest carbon intensity natural gas sources in North America. That matters because Shell's stated rationale is not just volume. CEO Wael Sawan described the deal as alignment with Shell's strategy to deliver more value with fewer emissions. ARC's production sits at 374,000 barrels of oil equivalent per day, with liquids at 40% of production but generating 70% of revenues. That ratio, high-value liquids from a gas-weighted asset, is the precise combination LNG buyers want. The strategic logic connects directly to LNG Canada, the liquefaction terminal at Kitimat, where Shell is already a partner. ARC's Montney acreage sits adjacent to Shell's existing Groundbirch and Gold Creek assets. Combined, the two companies hold over 1.9 million net acres in one of North America's most prolific gas formations. Shell's production growth is now projected to run at a 4% compound annual growth rate through the end of the decade, up from 1% before the deal. Here is where the picture becomes harder to read. The same oil crisis that is inflating Shell's strategic rationale is also the central bank's primary concern. If oil prices remain near $110 and begin to pass through into broader goods and services inflation, Macklem said the Bank of Canada would tighten policy. Higher Canadian interest rates raise the cost of capital across the economy, including for the energy sector. Shell is betting that oil-driven inflation remains temporary, that Brent crude retreats from $110 towards $75 by mid-2027, as the Bank of Canada's base case assumes. If that assumption is wrong and inflation becomes entrenched, Shell's $16.4 billion deal closes into a Canadian economy under active monetary tightening. There is a second tension. Rogers Communications announced on Monday it is offering voluntary buyouts to approximately 10,000 of its roughly 25,000 employees, one of the largest potential workforce reductions in Canadian telecom history. The company cited regulatory pressure and cut its capital spending by 30%. That is not an energy story, but it signals the same underlying pressure. Canadian businesses are contracting in response to cost uncertainty, not expanding. Shell is moving against that current.
Shell's acquisition thesis rests on two conditions holding simultaneously: that global LNG demand grows as Europe and Asia continue to reduce dependence on Russian and Middle Eastern gas, and that Canadian regulatory and pipeline infrastructure does not again become the constraint it was in the 2010s. Both are plausible. Neither is guaranteed. The historical comparison is instructive. When foreign majors last entered Canadian energy at scale, ExxonMobil in the oil sands, Total in Alberta's heavy oil, the entry points looked rational on paper. What they did not price was the decade of regulatory paralysis, social license costs, and ultimately the ESG-driven write-downs that followed. The Montney is a different asset from the oil sands: lighter, cleaner, faster cycle. But the institutional memory of what happens to large foreign commitments in Canadian energy is not short. The Bank of Canada's updated projections assume Brent crude falls to $75 a barrel by mid-2027. That is the path under which inflation returns to 2% without further rate increases. If oil stays near $100 or above, Macklem said the bank would implement consecutive hikes, and the Canadian economy would face a materially tighter financial environment than Shell's deal case assumes. ARC Resources shareholders will receive $32.8 per share, 25% in cash, 75% in Shell shares, with closing targeted for the second half of 2026. That means the deal closes precisely as the Bank of Canada makes its next several rate decisions. The evidence currently leans towards Shell having identified a durable structural opportunity. LNG Canada's Phase 1 is advancing, Montney's cost structure is among the lowest in North America, and the geopolitical shift away from Middle Eastern and Russian gas is not a cyclical trade. Those factors do not disappear if oil corrects. What they require is that Canadian permitting timelines hold and that LNG offtake contracts materialize as projected. The verification benchmark is the Bank of Canada's June 10th rate decision. If oil is still near $110 at that meeting and Macklem signals a hike, the market will reprice Canadian energy equities in both directions. Shell's new Canadian footprint becomes more valuable on the revenue side and more exposed on the cost of capital side. That tension does not resolve cleanly. The question is not whether Shell made a reasonable bet. The question is whether the same energy crisis that made the bet attractive will also make the environment in which that bet operates materially harder.